everyone should be able to hear me now. So anyways, back to the daily chart. I mentioned that today had a high one buy on the daily chart from yesterday. And because of that, I thought that there could be sellers above the bar, and they would probably sell for a scalp. So in other words, probably sellers above. And if they did go down, they'd probably scalp out. I also thought there might be buyers above and buyers below. So even though traders, the bears did a good job selling above for a scalp, it's a second entry buy. You can argue it's a breakout above a channel, but the reality is it's a breakout above almost 200 bars since over here. And that increases the probability that the bulls will get a second leg up. So to me, we may test the breakout point February 2nd. We may test the breakout points here. Depending on how deep the pullback is, will increase the probability of more trading range price action or more sideways, more trading range price action or a second leg up. $4,300, the big round number. On the open, we gapped up on bar one. Bar one, relatively decent size bull trend bar. And it's a strong enough breakout that we'll probably get a small second leg up. It's a bull breakout of a trading range, good for the bulls. You can argue it's possible exhaustion after this rally from here, but strong enough bull breakout, probably at least a small second leg up. Big bar on the open, so added risk that this could be a trap, trapping bulls into buying too high. In other words, the risk for the bulls is this is an exhaustion gap and a buy climax test of 4,300 in support. It's also an upside breakout above yesterday's high, this blue line right here. 2 consecutive bull bars, but big tail above. Strong enough tail on the bottom and tail above increases the probability of more trading range price action. You can see the bulls on bar one, you can see the bears on bar one that sold the close made money. So this tail below bar two is a warning that this might lead to an early reversal. If bulls were so eager to buy, why did the market pull back more than 50% of the prior bar? Three consecutive bull bars. And it's also a small 2 legs up on a smaller time frame. The market rallied, pulled back, rallied, or you can argue 3 pushes, rallied, pulled back, and another push. Either way, 3 consecutive bull bars, probably buyers below, scaling in lower. 4 is a bear bar. It's a sign of disappointment. For the bulls that bought the close of 3, they would probably buy more lower. But 4 is an inside. It's not an inside bar. It is almost an inside bar. But 4 is enough disappointment that a lot of bulls who bought the close of 3 will probably look to scalp out on a retest of the close of bar 3. So bulls buy the close, they scale in lower, they scalp out. And that's what happened on the next bar. 5 outside down, the surprise bar. A lot of the bulls who tried to buy down here scalped out, and if they didn't, the market reversed down. So it's basically a micro double top. We went up, and down. 5 is a big enough outside down bar closing on its low that it will probably lead to a small second leg down. If you're a bull and you bought the close of 1 and you're still long on 5, what do? You probably exit. Odds are 5 is big enough to get a second leg down. And then 6, the market reversed up. Is 6 a credible stop entry buy for a second entry buy? High 1 above 4, high 2 above 6. You can argue that, but I suspect a lot of the bulls who bought and scaled in are sufficiently disappointed, and this might be a trap, trapping traders into buying high. If you're a bull and you bought up here, are you disappointed or happy by this follow through? The reality is you're probably disappointed. So there might be more sellers above, but we could easily get above 5 before we get a second leg down. And then 7, we went outside down. You can see the market failed to close below 6, so a sign of decent buying pressure. For the bulls, it tested the open of the day and traders bought it, but 7 is a strong enough surprise bar. It will probably get a second leg down. You can argue 7 is already 2 legs down, sell off on 6, pull back on 6, and sell off on second leg on 7. Big enough tail that there's probably buyers somewhere down here, but the reality is we rallied and sold off, and you're at important support, yesterday's high, this blue line right here at 42.94, and the market may fail and try and test somewhere in here. Inside bar on 8, probably buyer. It's a low one short for the bears after the breakout below 6 during 7. Probably buyers below 8 scaling in lower. And then 9, we have another bear bar. It's an outside bar. Strong enough bear breakout below. Let me back up. 9 is an outside bar. Still probably buyers below 9 and buyers below 7 here. But this is becoming a tight bear channel, which increases the chances that the first reversal up will fail. If you're a bull, you could see this as a tight bull channel, consecutive buy climaxes. Reasonable to test the one low. Now, the one thing bulls are wondering is this is probably a trading range, which means there's probably buyers somewhere down here. But tight bear channel, you can argue bulls are buying below bars, but they're probably scalping at best because the first reversal up is going to fail. And then on 11, we have a bear breakout, a surprise bar. Is it sell to close? It is, but you're selling rather late in a leg down, and the leg down has a lot of tails below bars, so that increases the chances that the market will have a pullback. But if you are selling, better if you can scale in higher, because probably 2 legs down, leg 1, pullback, and leg 2. And then 12, we have a reversal bar. You can argue it's a wedge with 2, 7, and 12, or you can argue it's a wedge with 7, 10, and 12. 13, bear bar. It's a low one short. And the problem here for the bulls is it's basically a parabolic wedge. You can argue down, up, and down. But either way, tight bear channel. So this wedge has a higher probability than what it appears to fail. Typically, wedges have 75% chance you get 2 legs sideways to up. But here, greater risk of a downside breakout. 13, surprise bar, closed above the midpoint. Looks like a bear leg in a trading range, but it's a fairly tight channel. So I think the market will have a deep pullback, but the reality is we've seen the high of the day, and the bears will scale in higher. 15, another surprise bar, starting to get consecutive sell climaxes. Sell climax on 7, sell climax on 11, pullback, sell climax down to 15. 15, probably exhaustion, and probably will test the high of 15 and maybe test the high of 13, but the first reversal up probably will fail. Another sell vacuum test of the 60-minute moving average, this blue line right here. And then 17, we have an inside bar. Inside bar, it's a doji late in the sell-off that started on 4. Probably buyers below 16, scaling in lower. And then 17, we broke below 15 and 16 and reversed up. Some of the bulls that bought the 17 low or the 15 low disappointed that the market broke to the downside and didn't pull back much, and they may get out at their first entry with a profit on any scale-ins. And then 18, reversed up. Strong enough bull bar, probably going to go a little bit higher, maybe test the moving average, but probably not going to go that much higher. So bulls, what about always in? What do always in bears do? I think it's reasonable for always in bears to exit here. The pullback could be a lot deeper than what you think, and it's possible we test up to here, although we probably won't on the first attempt. You have to always wonder, open of the day is a reasonable magnet. 19, consecutive bull bars. Is it not yet always in long or by the close, moving average just above, and we also have the bar, the low one short on 13. just above as well. Some bulls, they bought the low, they got trapped on this bar, and a lot of them would exit. They'd buy, they'd scale in lower during 14, get out, break even. But some of them held, and because of that, this red line at the 13 low is a magnet. 20 is it's a doji, so bodies are getting smaller ever since 18, but 3 consecutive bull bars, probably buyers below and at least a second leg up. And 21 pulled back. Some bears who sold down here, scaling in higher, trying to get out break even. The bulls, they know that, so the bulls buying up here are also scaling in lower. Same thing on 22, and then 23 is an inside bar, possible 1 bar final flag, and probably buyers below 23, buyers below 22, buyers below 17. And then 24, a second leg up. 24, a little bit of a surprise, probably at least a small second leg up and test of the 13 low. 25, good bar for the bulls, breaking above the moving average. Possible 2 legs up and a second leg trap, but at the moment, probably buyers below any bar and at least another leg up. And then we got a surprise bar on 26. 26 trapped any of the bulls who bought the close of 25. So a little bit of surprise, probably going to have at least a small second leg, probably a small second leg up, but this bear bar is enough of a surprise. They may get a small second leg down. And then 27 trapped a lot of the bulls who bought this low, scaling in lower. 2 legs up, so leg 1, pullback, leg 2. You can argue it's a low too short, above the moving average, and a test of this area right here. And because of that, low 2 second leg traps often lead to trading ranges more than bear flags. But because you're in a bear trend, you have 2 legs up. We're probably in a trading range, but you always have to wonder if this is the bear flag that will lead to a measured move down. And then 28 is a bull bar closing on its high, just under the moving average. You could argue it's a credible stop entry buy, but the reality is a lot of the bulls who bought the low of 25 and more lower during 27 will use 28 to exit any remaining longs. So 28 might be a pullback for the bears. You have disappointed bulls who bought in here, scaled in lower on 27. They may just get out break even. Bears know that, so bears will sell aggressively, trying to prevent the bulls from getting a strong entry bar. In 29, a big bear bar, breaking out far below 27, breaking below 17, still probably buyers below scaling in lower, but the size of 29 might be strong enough to get a second leg down. And then we have follow through on 30. That is a problem for the bulls. So a lot of the bulls who bought and scaled in lower may be disappointed enough. You could see they were disappointed enough that they bought more lower on 39, and they got out around break even on this pullback, which led to a second leg down on 30. And then 31, we have a bull reversal bar closing the gap. So the bulls that bought the 27 or 28 low, scaled in lower, made money. Good for the bulls. The problem the bears have in here is the bulls have a lot of buying pressure. And typically, when you get a bear channel or a sell off like this and a lot of buying pressure, bull bars closing above prior bull bars, strong consecutive bull bars closing above their midpoints, closing above several bars to the left, increases the odds that the market's more in a trading range, and any sell off you get will lead to sideways trading. 31, strong enough for a second leg up. 32 is a doji. For the bulls, they see it as a pullback after 31, and they expect a second leg up. For the bears, they see 31 as a pullback from the sell off down to 30, and they see 32 as a pause in the selling. Therefore, you'll have bears sell the close of 32, hoping for lower prices. But low one short, probably buyers below, scaling in lower. 33 closed at the 32 low, so not as strong as the bears could be. And then 34, we have consecutive bear bars, 3 consecutive bear bars. Does it sell the close? I don't think so. I suspect there's probably buyers below, scaling in lower. 35, 4 consecutive bear bars. Good for the bears. Probably going to go at least. It might be strong enough for a second leg down, but the reality is there's probably buyers not far below, but it's certainly a problem for the bulls. Give me just 1 second. Thank you. I was saying 36, 5 consecutive bear bars. Generally, in a trend, there's sellers above a bar like 36. However, on a day like today, when you have a micro channel and it's any possible wedge, especially when it's a trading range, lots of bull bars closing on their highs, a lot of overlapping bars. You are in a bear trend, you're below the moving average, but you have to ask yourself, is this a bear trend that's going to last all day? Or is this a bear trend that's probably going to evolve into a trading range, which means it's a bear channel? And I would argue it's more of a bear channel than a strong bear trend. So there might be more buyers on the 36 close than sellers. And then 37, we have a strong reversal bar. For the bulls, 37 is strong enough for a second leg up. The bears, they hope it's a double top with 32, and they want a bear bar closing on its low with 38. And then we have a doji on the following bar. Probably buyers below 38, scaling in lower. Some bears who sold the 36 high and more higher will probably look to exit break even, and they might try and exit back at the 36 high. So the market may pull back all the way down here before there's a second leg up. 39, another bull bar, but it's a second leg up after the 37 bull bar. 37 was a bull breakout. We had a pause on 38, and then 39, we had a second leg up. And then 40, you can see traders sold it. So a lot of traders, they bought on this bar right here, 37, and they thought there'd be a second leg up after 38. And because of that, they were not willing to sell until they saw this doji. And the reason they would sell above it is it's 2 legs up on a smaller time frame. Leg 1, pull back with the doji, and then leg 2, and everybody sold it. It was also a test of the moving average. 40 is a bear bar closing on its low, and it's an outside bar. After a micro channel with 36 to 40, probably buyers below 40 and is scaling in lower, but you have to wonder, with it closing on its low, it might trap the bulls. So a lot of traders, when they look at this, there will be plenty of bulls buying here, scaling in lower, and they're betting on a second leg up from this. It's kind of like over here. We have a rally, they'll buy, betting on a second leg up. And then you can see what happened on this bar right here, bar 40. 40 is similar to this bar right here, which is 37 yesterday. We had a sell-off, a strong rally, and then we have a low one short. In general, low one shorts have buyers below that lead to a second leg up. High one buys have sellers above that lead to a second leg down. And this was a strong enough entry bar that the limit order bulls who bought and scaled in lower got trapped. And that's the same thing right here. So because of that, this is a strong enough bar that a lot of the bulls who bought and scaled in will probably trying to get out break even at their first trade or break even entirely. So in other words, they buy, they scale in, they get out at their first entry, profit on the second, or they buy, scale in, and they get out break even on the entire trade. Bull bar 42, but strong enough 40 and 41, probably a second leg down, and then low one short on 43. But look what happened at every new low. New low, buyers, new low, buyers, new low, buyers. So probably buyers not far below. It's possible we have to get to yesterday's low down here and make the market go outside down on the daily chart. But instead, the bulls got a reversal up. 44 is a strong enough bull bar, probably going to go at least a little bit higher. And instead, bear sold it. Why did bear sell it? Because look what I was talking about. Let me draw a line. You can see that bulls bought this low, scaled in lower, and they were so disappointed by the sell-off at a new low that a lot of those bulls ended up exiting around their first entry. And bears, they knew that, so bears started selling. 46, a bear bar closing on its low, trying to break below a bear channel. Here's pretty much the bear channel right here. It's a bear breakout, a little bit of a surprise, might go a little bit lower, but after 44, probably buyers below 44 scaling in lower. And then you can see 47, we sold off and reversed. Strong enough sell off below 45, similar to right here. Not the exact same context, but it's close. Low one short, strong breakout below, probably sellers on any retest. Low one short, strong, less strong breakout below, probably sellers above right here. The problem with that argument is it's consecutive sell climaxes in a bear channel. So you know the markets probably will form a lower high and get a second leg down. 48, we have a reversal above 47. 47 was a weak buy signal bar, but it's reasonable for bears to exit. Always in short bears to exit above. Too much risk of an upside breakout. 48, bad follow through. The bears that sold above 47 were able to make money, scaling in higher. 49 is a low one short, but after consecutive bull bars, probably buyers below. 49, bear bar closed under the 48 low. Still probably buyers below, scaling in lower. Yesterday's low so close, you may have to get there. And then 50, another bear bar. And then 51 reversed up. So you can see strong enough bull bar, probably forming a bottom down here. And with all this buying pressure here, 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 and now here, probably going to evolve into a trading range, which means the market's probably going to break out to the upside. Channels evolve into trading ranges, so any one of these lower highs are magnets. And I suspect at a minimum, we're probably going to get somewhere in here. 52, reversal down, second entry short with 48. You can argue 52 is a credible sell, but it's a sell at the bottom of a trading range, which means there's probably buyers below. If this does work, we could get a strong downside breakout. And instead, we got a reversal up, and you can see the market rallied up to this high. Is it by the close 55, 56? It is, but it's by the close if you can use a really wide stop and scale in lower, because we could easily pull back down here and go sideways. And you can see a lot of traders, instead of buying this close, they bought closer to these breakout points. The bears, there were bears who sold the high of 53 right here at 73.75. Why? Because every one of these, every bull bar so far today was sold. If traders sold above it and they sold above the high and scaled in higher. Here on 53, bears sold the high, they scaled on higher, but they got trapped on the way up. And because of that, there will be a lot of traders buying on a retest of the 53 high. Bears buying back, they're losing shorts, and bulls buying, betting on a second leg. So probably at least a second leg up. 57 is a high one buy though, and it has a strong bear breakout below 2 consecutive bull bars. That will increase the probability that there's sellers above 57 and the market goes sideways. 58, we have a bull bar closing on its high. Are there buyers above or sellers above? There might be more sellers above. It's a possible wedge, 52, 56, and then this bull bar. So if we break to the upside and reverse down with the bear bar closing on its low, I think it's reasonable for traders to exit. And we got a doji instead. Doji, are there buyers or sellers above? Are there buyers or sellers above? There's probably, that's a tough call, but the reality is trading range, we may just go sideways here. And then 60, you can see a lot of bulls that bought disappointed on 59, sold, and the market went down. And then 61, another big bear bar. 62, testing all the way down to the low one short. But you can see, even the bears that sold the low one and scaled in higher were able to make money. 53, another inside bar, and then we pretty much went sideways into the close. At this point, until we break above a major lower high, which at this point you can argue 45 was a breakout of a major lower high. And because of that, give me one second. And because of that, the market's probably going to go sideways. And we pretty much formed a trading range for the rest of the day. Over here, lower high or lower low major trend reversal. It's actually a perfect double bottom, but not enough time left in the day. And by bar 72 and the market's going sideways, it's probably going to end sideways as well. So overall, good job for the bears. Spike, pullback channel, I suspect will probably go sideways for several hours. So if I had to guess, the Globex chart will probably pull back somewhere in this area. For stop entries, it's reasonable to buy above 1. What about buying above 2? I don't know. I think 2 is more of a buy the closed bar. And if you're buying up here, that might be more where traders are taking profits. What about buyers above 6? I would not. Outside down bar, probably sellers above. You can sell below 8, but not ideal. I think more traders would sell below 9. 8 is a low one short, probably buyers below. And on 9, the bears got follow through. And a lot of those bulls that bought the low one on 8, when they see 9, a lot of them will exit. What about buying above 12? You can take it betting on a surprise breakout, but tight bear channel, probably sellers above. So not really that ideal. Plus, it's right under the moving average, which is not a good place for the bulls to be buying. In general, if the market is below the moving average, you really don't want to buy right at the moving average. You want to buy further down from the moving average. Okay to sell below 13, putting a stop above 13, taking a chance we break to the downside, maybe test the 75 low, and not really great stop entries in here. I thought 18 was reasonable, but it's minor at best, which means if you're buying it, you really need to be able to use a wide stop to scale in, so not ideal. Bears, probably okay to sell below 25 or 26, always in bulls, exit below. And 28, what do the bears do if it triggers? I don't know. I think the bears probably get out above 28 if it triggers, although it could just be a trap, trapping bulls into buying where a lot of the bulls exit and eh, trapping bears out of a good short. So bears that are sell, they exit above when the reality is what I mentioned earlier. There should have been buyers below, and instead it led to a downside breakout. So bulls will sell out of longs, and bears will sell to go short. And probably exit if you're still short. You probably exit above 31, probably exit above here, or actually exit a couple points above. Bears can sell, but micro channel probably going more sideways and not straight down. But instead, we got a surprise. So expect a second leg. But often the pullback can be deeper. So this was actually leg one, pullback leg two. And then if I was a bear and I was still short, you probably get out above this bar or 51, certainly above 53. Bulls buy. But if the bulls are buying and then they see a bar like 57, that's a warning that the market's going to go more sideways. And that's pretty much it. Not really any good stop entries in here. For limit orders, bulls probably buyers below 3, and you can see they made a scalp. And then outside down on 5, probably sellers above 6. Big bear bar, so a big breakout and then a deep pullback, probably sellers in here. Probably buyers below 8, but you can see a lot of those traders got trapped on 9 and 10, and they tried to get out break even. This is what I talk about all the time with limit order traders. When you're buying, let me zoom in. So if you're buying this low and then you see 9 and 10, if you're a bull and you bought and then you have a consecutive closes against you, especially when one goes far away, you're going to be more inclined to exit at your original entry. And you can see what happened. bad close on 9, bad close on 10. Then on this bar, it went up, got tested at the high. The high of this bar is 95.25. The low of bar 8 is 95.25, and then it raced down. And then it tried to test it again and then raced down. So it's a sign of trapped bears. Probably sellers above 12 or above 11, and probably buyers below the 75 low right here. And you can see as it got closer, bulls started buying, bears started buying back shorts, bulls buying below 75, scaling in lower. What about selling above 17? I would not. Consecutive sell climaxes. We may get a deeper pullback than what traders want to see. Plus, when you have a sell to close market like 13 or 14 or 15, and then you get a doji like 16, that is a warning that the market's probably going to pull back soon. And probably buyers below here for a second leg, probably buyers below 25, but you can see they got trapped on 26, 27. They'll use the pullback to exit. Buyers below 32, 33, 34, or the 30 lows. Sellers above 33, 32. On the rally above 39. And then probably buyers at a new low, but strong enough breakout. It was similar to over here. This breakout on 41 trapped bulls into buying here, betting on a second leg up, and instead we got a downside breakout. So probably sellers in this area for a second leg down. It's kind of like this should have been support, and instead it wasn't. So the low of 39 should have been support, and it broke strongly below. And because it should have been support, it wasn't. So a lot of the bulls that bought and scaled in got trapped, and the market proved it was resistance. So therefore, a lot of traders will sell on the way up, betting on a second leg down. And then limit orders below, and limit orders below here, sellers above here for the rest of the day. For buy the close, sell the close, probably buy the close 1, buy the close 2. But when you see 3, it's still buy the close. But a lot of traders, when you see 3, they'll be disappointed with 4 and then exit around their original entry. So they buy the close, disappointed 4, get out, break even. What about sell the close 5? Not ideal. There's probably sellers. If you're selling, better to scale in higher, and you really need to stop above the high of the day because we could easily go above it one tick and turn down. And then somewhere 9, 10, and 11, sell the close, but 11, best looking bear bar and the sell off, so you may get a deep pullback. And sell the close 13. You can also sell the close 14 or 15. But if you're selling the close of 15, it's like selling the close of 11. You're probably going to see a deep pullback and consecutive sell climaxes. So probably going to have a deeper pullback than what traders want. At a minimum, probably going above the 15 high. Can you buy the close of 18 or 19? You can, but you need to stop probably, maybe a measured move down of 17. So not really ideal. In fact, there's probably more sellers above, and then sellers above 23, 22 on the rally on 24 and 25. I thought there might be buyers below 25 and 24, but after this big of a bar, a lot of those bulls who bought and scaled in got out break even here. Buyers below 27, buyers below 17, scaling in lower, sellers back at the breakout point here, but I would not sell after a bar like 31. Probably buyers below 33, buyers below the 30 low, 31 low, which we got, and then probably sellers above 38 and 32 for a second leg down. Buyers below 42 for a scalp. But as I talked about, bulls that bought here got trapped on 41, and they'll use any pullback to exit. Buyers below 48, buyers below 52, but 52 is a little bit more dangerous of a buy. It's a second entry buy. 52 is actually a really interesting bar, and it's really common to get this situation. You get a credible stop entry, and you've been selling off for several legs, so it's basically a bear channel in here. Therefore, you expect 52 to lead to a couple of legs sideways to up, maybe test of a major lower high here or here. And whenever you get a major a credible bottom, you often get something that shakes traders out. So you get a stop entry like 51, but then you get a bear bar like 52, making the bulls question if they should hold because they look to the left and they say it's been in a bear trend all day. Maybe I should get out below 52 because it could go lower. And instead, 53 turns up and the market reverses. And that's pretty much, by the close 54, 55, maybe, but not ideal. And that's pretty much it. Let me take a look at questions. How do you find support and resistance in general? Can you go over briefly what you look for? So, support and resistance, if you think about it, it's what you think it is. Support and resistance is there's many ways to look at it, and you can look at the moving average, prior. I mean, if you really want to think about it, the prior bar, every bar has a support and resistance level. So here's a bar, the prior bar is probably resistance. So it all depends on context. For me, I first think about the market cycle. Every day, I look at yesterday's high, yesterday's low. So I draw yesterday's high, I draw yesterday's low right here, and I see how the market responds. You can draw bear channels, but support and resistance is any area where you think there's going to be buyers or sellers. So, like right here, this is a good example. There's probably buyers below, and instead we got a surprise breakout, and it led to a second leg because bulls buy, they get trapped and they get out. Bears, they don't sell thinking buyers below, and they get trapped out of a good trade here, so they sell a pullback. And that's really how support and resistance works. And a breakout leads to a second leg because it traps traders. In other words, it does the opposite of what traders think it should do. How do you keep emotions in control after consecutive losses? I tried to start throwing Hail Marys to dig it out. I think all that comes with experience. Everybody faces losses and you just deal with it. It's just it's another day. And, I think you have to realize that for one, you have to be in it for the long run. I think it's easy if you're just thinking of trading as kind of a hobby, then the losses are just going to kill you. But if you think about it as a career, you want to trade for the rest of your life, then the losses are learning points along the way. So for me, the first thing I would do if I had a bad day or did something dumb, I'm going to go to a PowerPoint. I'm going to screenshot the chart and I'm going to start drawing on it. So, if I sold below this bear bar and I didn't get out, I'm going to go to PowerPoint. I'm going to mark up the chart. What did I see? What did I not see? Maybe remind myself tight consecutive sell climaxes, but tight bear channel, probably a second leg down. That's going to be symmetrical. Therefore, leg one, pull back. Maybe leg two. Maybe, did leg two start here? Maybe. But either way, the point is that you have to learn from mistakes, and that just takes time. And you also have to be dedicated to learning. If the average swing range is 20 points and one should expect at least one swing per day, well, first off, there's many swings per day. What I would start with is you should look for an opening swing, but typically there's at least 2 or 3 decent swings a day. Anyways, what is the equivalent of holding for the above said average time it takes for a swing to take place? Yeah, I think that varies on the range. For me, the way I look at it is the day structure. So what's the day forming? So you get a reversal up and then a sell off like this. I'm expecting a lot of trading range price action. Why? Because bear trends don't start out like this. You don't get a strong buying on the open and then get a very strong trend. If you do have strong buying and then a sell off, it typically leads to more trading range price action, which you can see. That's basically what we got. We had a lot of trading range price action here, lower prices, and a lot of trading range price action here. But for me, typically the you could argue 10 bars, two legs, and or on the open, you can argue that the opening swing lasts a couple hours, unless it's going to be some sort of trend from the open that becomes too climactic and goes sideways. Was bar 12 a good swing? I don't think so. Tight bear channel. It's probably a minor reversal at best, which means probably sellers scaling in higher. Al says that one should go for twice their actual risk, but many times it's like for half of one times the initial risk on a scalp. Is it really worth it? Yeah, what this person's asking, Al says you should go for twice your risk, but when you're scalping, it seems that often your risk is less than one times your risk. And that's true. And that's why if you're scalping, you really need a high probability because otherwise you're just going to give up a lot of your profit. I've talked about it many times and about probabilities where a lot of traders, let me just see if I can pull this up. So here is a probability workbook, and if you've listened to me for any point in time, you have probably seen me show this. And the reason I like to show it is because I think it really simplifies a lot of things. So probabilities, let's talk about it for a minute. In general, there's two things you can control, and it's really one variable, and that is risk reward. Probability is set based on the trade you're taking and your risk and your reward. And in general, traders have two choices. They can go for, let me get rid of this and this one. Traders have two choices. They can go for one times the risk, where the probability 1-to-1 risk reward, and try and be 60% profitable. That will yield zero point 0.2. Zero point 0.2, I consider zero point 0.2 as being the minimum required to be basically break even when you factor in commission. You will not make any money at this level. Then the next factor that they have to decide on is, do they pick this, which is basically option one, or do they try and go for twice the risk? Twice the risk, if they can be 40% profitable, that will yield zero point 0.2, which, as we discussed above, zero point 0.2 is basically break even when you factor in commission, slippage, and just human error. So these are really the two choices that one has. They can go for this option, try and be 1-to-1. In other words, scalp and be 60% profitable or higher and make money, or they can swing trade and try and be greater than 40% profitable at 2-to-1 and make money. So the question here is, which one do you think is easier to achieve if you're starting out? It's obviously going to be the bottom one, because the top one, if you think about the requirements, the importance factor in this is risk reward. So your risk is 2, your risk is 1, your reward is 2. So it's a 2-to-1 risk reward. Here, it's 1-to-1 risk reward, which means the advantage a trader has here is probability. So if you think about it, your advantage on the bottom is risk reward. Your advantage here is percent probability, percentage. And because of that, you have to be very quick at making decisions here, because you really need this to be closer to 70% to make it worthwhile. That's the goal of a scalper at 1 to 1, if not higher. Here, 2 to 1, you have many ways you can play around with this. Let's say your average reward is 2.5. That's going to improve it dramatically. Let's say you can improve your probability by 5% and be 45% profitable. That improves it dramatically. So, here, if you think about it, imagine trying to be 70% profitable the whole time. That is very difficult for a lot, especially for traders starting out. But being 45% profitable, going for twice the risk, is much more achievable. Everybody gets frustrated because they realize that the market often will go sideways all through here. And if they buy below bars and scale in, sell above bars and scale in, they'll make money all day long. But it's very easy to lose money doing that. What confirmation do you look for if you're thinking about shorting from the high of the day? It varies on the open, the first couple of bars, and the context. Here, I thought it was reasonable. I thought we would test the high of yesterday. Reason being, the daily chart. I thought the bears that sold this high and scaled in other words, sold on the way up, would at least probably make money. All right, so that is all the time I have today. But thanks everyone for watching, and we will see what tomorrow brings. Today is a second entry short on the daily chart. So the bears, they want strong follow through, and the bulls, they want bad follow through and a reversal up for a second entry buy. I suspect even if the bulls get a strong follow through bar, it will probably be disappointing. But we'll see. All right. Hope everyone has a good rest of their day.